Good afternoon, guys. This is Steve O'Hare from Pia First. Welcome to our medium-term outlook on commodities and equities. And now, normally myself and Ian Coleman, my business partner, take it in turn. Normally he does the FX, and I do the commodities and equities and whatever else is left over. Ian's unfortunately away. It's his turn today, but he's away today. So I'm coming in and I'm going to give my outlook. I'm very happy to go over the Forex products as well. So as I've said before, I'd like to keep this quite interactive, and feel free to chip in, ask questions as I move along, and we'll try and keep this going smoothly. And we'll start with equities. Obviously, we're looking at the weekend news. Obviously, the real buzz in the air is the UK and whether it will decide to leave the euro or not. Cameron announced that we can take a vote on it in June, and that seemed to Sterling reacted well to that news, that he's negotiated a decent deal for the UK. But this was hit a few hours later with and over the weekend, with news that Boris Johnson, who is a major could look to be a major antagonist against the deal, and he's gone into the vote to leave Euro camp, which was a negative for sterling. And so we've got a few months now to plan exactly what's happening, for the campaigns to gather steam, and for us to take to the polls and make a decision on this in June. So in the meantime, obviously, sterling will remain elevated from a volatility perspective. It will remain under some sort of pressure, natural pressure, because obviously there's a bit of an unknown out there, and you know, traders don't like unknown. So I expect this will also filter into equity markets. We'll probably be hit by news bonds of one sort or another regarding how the campaign is going, or how the yes vote, no vote is likely to impact on markets. So obviously the main market to be affected from an equity point of view would be the FTSE market. So I'll start with FTSE, and then I'll pop across to DAX, which is a major player as well. So I'm going to look initially at the FTSE against the German DAX. So European markets, you can see that the FTSE on a percentage basis has been pressured, slightly heavier than DAX over the sort of like last few months. But there's some really interesting levels that we are approaching in FTSE, and definitely some levels that we've got to keep an eye on. This is a weekly bar chart which we look to for the long-term view, and to come up with our trade ideas, we look to the long-term view to get an idea of the major trends, and we break down to weekly and daily charts to get real entry levels for medium-term and short-term trade ideas. So FTSE on a weekly chart, we can see from the high of Q2 2015, we've been in a downwards trending channel. If I drag the chart back, you can see that this is a retracement, a correction from the 2009 move higher. So this is after the obviously 2008 volatility and banking crisis, all here. We recovered losses around 2011, and prices have just chopped higher until 2015, and we've had this major correction in 2015. Now, the main formation that I look at when I look at this 2015 correction is an ABCD formation, which is a normal formation that takes place in markets. The ABCD is basically a great formation which we can look to give us a predicted bottom of a sell-off before buying kicks in again. Now, to get it, we measure the point A, the high point, to the major swing low, and we expect that to replicate after a correction. So we're looking for a move down to 51.32 if that was to complete. Now, if we break it, we want to look at a more medium-term trade. So what we're looking at now, we've obviously got this downtrend line, which has capped prices for almost a year, and we've got lower highs, and we're in the midst of a minor correction higher. Now, this candle here that I'm pointing to, the third candle from the right, is what's called a bullish hammer. This is a rejection of the lows and a correction high. Remember, this is a weekly chart, and then following this, there was a positive candle the following week, and this combination of three candles, the large downward candle, the bullish hammer, and the positive correction higher following candle, can also be seen as a morning star formation, which is a very positive move. This move that we're in the midst of still has further to go. This week has started positively. Equity markets around the globe have all started more positively. So we can see that this is probably targeting, at least at a minimum, it's targeting this just above the 61 area. The downward trending line of resistance comes in at 61.90. Well, let's give an area 61.75 to 61.90. So nothing really holding this back at the moment. We have if I break it down to a daily chart, there is a small resistance around current levels, and that's coming in there today. This is again from the last 3 months of lower highs. Coming in today, we've also got the daily Ichimoku cloud, which will lend some resistance. So we expect, really, on a daily basis, we were looking to buy a dip this morning, didn't quite get to our level to buy. It's carried on high, and this was around about our target level, around about the 60. Let me just bring up our trade idea. Maybe I can jump across and show you it. For some reason that is not showing me it, so we'll stick to the chart. But I can tell you that we were looking at buying at 59.80 this morning in FTSE. It hasn't quite got there, and it's trading around our target level. Our target level today was 60.40. So that's the area we're looking at capping prices today. But as I say, jumping back to the weekly chart, there's still more room to the upside. So at present, we'd be looking to buy dips from around about the mid 59 area, targeting a move towards 61.20, which will be a 38% retracement. Now let's pop across the DAX. As I say, I want us to keep this reactive, so anyone who wants to ask a question, if I jump ahead too much, please let me know and I'll slow down and go over it, because I want you to understand what we look at, and hopefully in turn it will help you or assist you in making your more informed decision by us making a call on technical analysis. You may have a fundamental view, but you can obviously combine these two. And if we're all singing from the same hymn sheet, then there's more chance of that trade being a better trade. So DAX, we're looking at the weekly chart again on DAX, and a similar, if we go back to 2009, the low in 2009, the move higher, correction, move higher again, a 5-wave up move. Obviously, we're going through a corrective process here. And again, it's like an ABCD corrective move lower. This target's 85, around about the 8,500 level. Prices, let me just remind you, this is a line chart. So this won't actually show the intraday highs or lows. It will just show the closes on a weekly basis. So you can draw support trend lines from this, which might not look like correct support trend lines, because it might only look like 2 points are drawn in, when in fact, if you drill it down to a daily, that there'll be at least 3 points on a trend line. So again, we're looking for this to move lower still, although we're in the midst of a correction. This is an interesting daily chart we've got drawn up. Again, we've got the 3 trend line points coming in, and we're looking for this resistance again around a 38.2%, 97.36, and we're in that trend at higher, and you can even draw a very steep trend line, which will give you an indication of whether this is actually running out of steam. We have a MACD below, an indicator which is the moving average convergence divergence signal, and this can also give you an indication of whether the momentum is running out of steam or not. So the daily chart has decent resistance above the each moving cloud above, 38% retracement, a natural retracement. If it makes it to here and then retraces, that would be considered normal. But the actual gap in the charts is something to be very aware of, and we've been quite reserved on this up move because of this gap, because gaps do tend to be filled. This one hasn't been filled straight away, but it will be something to bear in mind, you know, when in the future when prices do come lower, which we do expect. So we're looking on a daily basis. Again, we were looking at a shorter term resistance levels that we were getting short around about this this area this morning. And if I go to my hourly chart, I think there's been a problem with this chart this morning where prices, Deutsche Börse shut down for a period this morning. I haven't seen the explanation why, but it caused a blip in the markets where a lot of, obviously the DAX feed ceased, and a lot of these platforms that are you know, produce their prices based on a products feed weren't able to produce prices for quite a period of time. So we'll have to just maybe, I know the market around this couple of hours drifted a bit lower, but ended up just ranging between a 20 to 30 tick range around these highs. And we've seen, as the markets have opened up again, a small down push. So as I say, no real reason given yet, but we'll try and find out more information about that. But we were looking to sell the DAX this morning. There was a couple of resistance levels that we had on our bespoke analysis, which we don't publish, but we use on a daily basis to get our intraday calls. And we were looking to fade into this 95.40 area. Our stop was 95.90, hasn't been hit yet on the daily basis. But from a medium-term perspective, obviously there's still a little bit of room on the upside. But again, this is equities have been pretty volatile over the last few days. Hasn't been any real trend in it, so it's been very choppy and very difficult to trade and call. But from a medium-term perspective, we would look to be selling into rallies around about this 97 area, 97 to 9800 area. Stops on this trade remain above 10,000, so that's a 200 to 250 point stop, which is a big stop. But you know, its size can be adjusted to take that into account. And hi Pan, I'll come back to. I will mention gold in a second. But yes, well, I can mention it actually now because obviously we're talking about equities, and gold do have a correlation. People are quite bullish on gold because there is a lot of nervousness out there. There's you know, economy around the world is in a bit of disarray for one reason or another. Obviously, the nervousness over the Brexit, Britain leaving the euro, has inflamed this. So we've seen gold continue this push higher. It's a safe haven bid, and as equities plummet, but we're seeing it very choppy, where equities may come off for a couple of days, gold would rally for a couple of days, then you'll have a reversal, so gold will come lower, and the correlation is definitely in there. So you have to be aware of other markets when you're looking at. You may be concentrating your stuff on DAX, but be aware of other markets because it can allow you to get a better insight, get a better entry level, because there's plenty of times during the day you can be bearish on DAX, the market could rally, but you could still make money if the timing is right, because it has in a 200-300 point rally in DAX, you'll have 100-point pullbacks. So there's always plenty of potential out there, even with markets rallying, if you're trading it from the short side. I'll come on to Nikkei as well. I mentioned Nikkei. Yeah, so we'd be, as I say, we'd be looking at set shorts around about 97.50 to 9800, 250 point stop. Target on this would be this gap down here, this close, this gap between 89.70 and 90.70. So it's a 100-point gap. So that would be our first target. Then obviously second target would be around about the 86, 87 area. So I'll let me just bring up Nikkei. Nikkei, let's bring up the Nikkei index. If it'll allow us. That doesn't look like it's going to allow us. Just get round to this a Nikkei chart. Let me clean it up a little bit first before we carry on chatting about it. Very evident here over the last few days that we've had a sideways trade range where it was choppy last week and not getting any real drive out of it, just nervousness over the next big move, really. But if we look at the daily chart, again, we can see that prices have moved lower since start of Feb, and where we've retraced, but are capped at present. buy high of around 16,340. Although we've had a move up after last week's lower close, this may be limited on the upside on a daily perspective, and definitely for a as this corrective move continues, we could be having a little bit of a maybe ABCD correction, which will take us up to around about the 17 level. But it has to break this level of that we've got in here. That's just part of an Ichimoku cloud level that we draw a nice horizontal line to make it a bit more stand out a bit. 16,340 is Nikkei daily. Is it a cup and handle? You can say it. I mean, a lot of the formations cup and handle, especially, not so commonly used. I look at them. I don't really use them an awful lot. Let me break it down into a smaller pattern. I mean, it depends what time frame you're using as well. A lot of the larger patterns are great. Like the large time frame patterns are great to be aware of. But I would maybe avoid using cup and handle on this. There's probably stronger formations that are in play. I mean, the range that we're seeing over the last week or so is quite clear. It's been ranging between these levels, and I think that will continue, to be honest. So I'd still be looking to set shorts until we get a clear break and close above the 16,340. That's a daily perspective, obviously, but also that would equate to the medium term move. If it does close above this 16,340, then it's broken these highs, which has been offered good resistance. Then this line 16,340 will turn into support and could project a move higher towards the 17,000 level. Obviously, if we flip this back to the daily chart, we can see that the daily cloud and also this resistance around 17,000 will come into play. So still, we'll have a little bit of a wait, and I'd be looking to sell this on a daily stop above 16,340 on medium-term perspective by a break and a close above this 16,340 within reason, looking for a move up to 17,000, but still remaining bearish over the more longer term. Again, that trend line will come in there and interfere with the attack on 17,000. So let me just take you back to charts I'd set up. Forget about Nikkei, we've done that. And we can do a bit of US equities or commodities. I'll jump to commodities. Obviously, oil, another buzz product at the moment that everyone's talking about, and we get obviously dollar CAD is quite a key product, as I was saying before, looking at other markets and what's going on in other markets to give you a better idea, maybe a more informed decision on how to approach the product. So we're looking at dollar CAD against oil. Obviously, Canada major supplier to the US, who's a major consumer of oil, and you tend to find that as oil prices go lower, dollar CAD goes higher. So this is evident in this chart, and you can see that dollar CAD currently has rejected a move above 145 and is trading lower, and it broke. I did a piece a few weeks ago about it breaking around about the 140 area. There was some major support and formations taking place there, and this is staying under pressure. Everyone's obviously with oil bouncing back a little bit, then we could, you know, it's correlated inversely. So this dollar CAD remains under pressure, and this has given a little bit of support to oil. There's other oil producing nations looking to freeze oil output. Again, I think they're doing this in the hope that this will cause a squeeze, but it's a very unnatural thing to do, to freeze oil production, and therefore it may be a short-term blip, in my opinion. I'm still bearish on oil over the long term. I was trying to find a little bit of reason why maybe this oil could go higher, and that there's what you could class as a double bottom, although it's not an exact double bottom, because obviously the candle is lower, only by 75 ticks, so it's not a great deal in the large scale of things. But obviously a double bottom would require a break above $35, which at this point in time, again, I don't think we're going to see. This is, let me just point out, this is actually a March chart. This is a continuation chart. So let's hop across to April to give the front month analysis on this. And I'll take this down to a daily. And we can see there's only a few candles to look at, which makes it difficult in this rollover period. So Pan just mentioned you've got a problem trying to figure out retracement levels in oil. Well, I'll try and do it for an obvious one would be to transfer the trade over. Let's get a Fibonacci retracement from this rally higher. We've got 78.6% retracement coming in at 32.92. Now, as March transfers over on the continuation chart to April, we'll see prices jump up here. But then as the continuation chart continues, this is how it works. It's not an exact science, or not easy to transfer them across. But basically what we've got to do is to try and pick up on levels which continue to hold, and good retracement levels which we can rely on. 61.8% is a, let's start again. 38.2 is a normal retracement, 61.8 is a general retracement, 78.6 is one of the largest retracements we look for. So that comes in around $33. Obviously prices last week topped out around about 31.95. What I could do is bring it up. If we add, if we add oil US April, this will give us a bit of an idea of where you can see the April is the orangey candles, and you can see March is the black candles. So March currently trading at 30.72, April trading at 32.97. So this is coincides with that resistance we have in, let's delete April now, 32.97. Which coincides with the 78.6% retracement. So once April transfers across on there, if we were still trading around these levels, you'd get a peak up here. Now the daily continuation chart on the continuation chart on the oil as a whole is around here. So April will be finding resistance around here, the April contract. Although if you look at the daily chart here, and then try and add Ichimoku cloud on here, you don't get a great picture because of the amount of information that's available for that one contract. So let's make a call on this. We've had obviously a rally today after 2 negative days. This was looking like a decent reversal formation last week when we had Thursday, shooting star type candle, not quite shooting star. And then the bearish day on Friday made it look like an evening star formation. But prices have reacted higher this morning and moved higher. And currently is finding some resistance just below $31. Medium term perspective, we're still bearish at this, and I expect this to be a typical ABCD for correction, and we're looking for lower levels again down to sub $25 within a week or so. So let's keep an eye out on that one. I look at gold as well. That's as we just spoke about, has this correlation with equities at the moment with the safe haven bid in gold. Prices topped out around February. Let's bring a DAX chart up here, and we can see how it's inversely correlated. And again, this is what we can when we can use other charts. When you get this is the DAX down here at the bottom. And we can see an inverted hammer on this candle after a sell-off 4 hours previously. And prices, that was a bullish signal for DAX. And obviously gold at the time was making new highs. But then gold produced a very bearish looking shooting star, confirmed 4 hours later. And the correction had already begun in the equities. And that correction, after markets closed, gapped higher the next day. That's the gap on the charts that we talked about earlier in the DAX. And gold has since been hit quite hard. But you can obviously see that there has been decent support in gold. I mean, if this was completely correlated, really from here, gold should have moved further, should have moved lower. So there is a slight detachment there, and you can see again when prices topped out in DAX and came off, you saw the reaction higher in gold. Again, it's you're seeing, if you see candle confirmation on 2 different markets that are inversely correlated, then it's like a double signal, and it gives you more confidence. And you know, if you tie that in with the unknown and the nervousness in the markets, then you can come up with a really good signal. Yeah, gold is I can understand, Pan, you expecting gold to fall, but it's a great recovery. Yeah, I mean, I picked out a level. I think we were trading around about 12.30, around about here. I wrote a piece for Saxo saying that I was looking to buy a dip in gold at 11.91 or 92. I can't remember what I wrote now. And it got to within, it got through it by a tick, and it's rallied off there. So it's, you know, for me, a good call. You know, you get good calls, and you sort of you sort of like, you believe in them. If they work that well, it's good to, you know, it's a good feeling for them to sort of like actually hit the level and then bounce off. But obviously, and then we had the extension higher last week, so that everything looked good. But then we hit a bit of a wall, shooting star candle, projected the prices lower, and this is where again you get the equity rally, equity recovery. But I don't really believe in it. I still think equities are are really overall that they're under pressure, and it's going to be hard to shake this pressure while there is the Brexit question is going on and other things from around the world are happening. So gold for me is a buying a dips and looking for higher prices. Let me bring the daily chart in, and you can see that how prices have broken through downward trending resistance. We had a double bottom here, which was confirmed and broke higher, achieved the level at 1131, and then extended much higher. Then we bring in the previous resistance line, and that's where I came up with my buy idea, and it's bounced off there. So as you can see, the volatility, the escalated volatility is pretty much all we're looking at the moment. Now, the medium-term outlook in gold, as I say, I'm continuing to buy dips and wouldn't hold on too long. Obviously, if we broke the 1190 level, I think the stop I had on that trade was about 1170. Obviously, a clear break and close below the 1190 level would jeopardize that call. But at the moment, we're seeing lower highs, and this this solid support that I have drawn is also now backed up by trendline support. So a little bit more reason to look for this. Yeah, got in around 1612. Yeah, I can believe that. It's funny. We've been positive of this today. A daily call was to sell gold at 1217, and it feels so wrong to be doing that when your medium-term view is higher. But it worked. It worked. Our target was 1200. And it got to close to the target. It bounced from 1205. We took early profit on it at 1207, and then it sort of did make a move for down to 1202. So was an okay call, but it feels, it does, you know, it's difficult. It's hard to pull the trigger, but you just have to have that belief in what you do. You've got to make sure that you have a trading methodology that you stick to, that you never wave from, and make sure it has a good risk reward component. We attempt to make all our trades at least a minimum of 2-to-1 risk reward. So if we are willing to risk 100 points or 1 point, our reward needs to be at least 200 points or 2 points. And if you stick with that sort of formula, then you can get more trades wrong than you do right. But if you also have a good methodology behind your trading, you don't overtrade, you have discipline, and there's reason, and you stick to that plan, then you have more chance of success than just being sitting there just clicking the button every which way. So that's it. It's a key thing. It's you know, this is like just key points to remember. But here we have this is like a descend. Well, I mean, you could call it a pennant type formation, but descending triangle. This would be a continuation pattern when you've got the move up from here, and you've got the you've got the extension higher if once we break above this resistance. So again, we're looking to buy down to 1190. Stop. We put a stop on a break close below 1170. That's a 20-tick risk. 20-tick risk at 1190. At 1200, if you get at 1200, it's 30-tick risk. But we're definitely looking for this market to move higher. Again, 1260 would be an initial target to make that risk reward 2-to-1. You're going to find some resistance at 1240. So again, if you can sort of build your position slowly, have a defined stop. There should be opportunity over the coming weeks to take profit a little bit higher. Yeah, so I mean, I've covered equities, oil and gold. Any other markets you want me to look at, I'm happy to do so. We obviously had a little look at Nikkei 225. I'll just hop across to the dollar index. Obviously, dollar's key. It's it's the major currency. It's linked to the gold, how gold is quoted, how oil is traded in dollars. Although there's a few countries out there trying to change all that. But let's have a look at the dollar index. And obviously, this is a monthly chart from the disastrous 2008 crisis. The correction back didn't take very long, and prices have dollars strengthened over time and hit the 100 level towards the end of last year. Well, earlier in the year and again towards the end of last year. Hasn't been so rosy for dollar since the turn of the year, and it remains pressured. But also there's a little bit of a few formations going on to be aware of. Not really a flag formation, but once the formations are complete, there is potential to move higher, up to 115, possibly 2000. You know, I mean, we're looking at a long-term projection. This is a few years, but obviously there has to be a little bit more consolidation here before we can confidently look for that level. But I think we all want to, if you're anything like me, we want to see our profits booked in by the end of the day. So we have a look at the dollar today. Obviously, dollar strengthened today. There's also a little bit of a hint of maybe if we break it down to a 4-hour chart, maybe a reverse head and shoulders pattern forming, where we draw a little shoulder here, head here, neckline. Could we say that's a neckline? Possibly. I mean, basically a clear close above 97.50, which is exactly where we're trading now. And that could be a little bit of a sign that dollar's back in the game. So watch that carefully. That's definitely something which should be decided. That's a 4-hour chart. So depending on how the rest of the day goes, that could be very interesting. Be looking to get long of the dollar index on a close above 97.50. We can project where we expect that to go to. Again, and that's back towards just below the 100 area. So depending on how this plays out, could be an interesting time over the next couple of weeks for the dollar. We have a quick look at cable. Again, we look at the weekly chart. It was something I picked up on this morning. Obviously, Ian normally does the FX majors and crosses, along with Harry, and you know, he's very in tune with the markets. But technical analysis is technical analysis, and we can all read a chart. But every market has characteristics, so it does make, you know, it does make sense to sort of have you know, your markets that you focus on, it does turn into better performance. We have found a lot of performance and analysis of our performance can be found on our website at pia-first.co.uk. Yeah, but the one real thing that I found today, looking at this, that screams out is this support in cable, 138 upwards basically, and we're under real pressure. Cable's under real pressure at the moment. Now, again, talking about formations and head and shoulders formation we just talked about. This won't be a head and shoulders formation. Head and shoulders formation is if we had a rally, a strong rally into a consolidation period, left shoulder, forming a head, right shoulder, and then a sell-off. That would be a head and shoulders formation. This market has been chopping around these levels and gone straight into it. So you can't. I wouldn't be looking for a head and shoulders formation, but a break of 138, and that's you know, cable is going lower. But we're more looking at the medium-term trend. So let's skip that, but remember 138 as a key level. Again, that would be a level that, from a day trading perspective, you'd be looking to maybe looking at that level. If the market tests that level, judge by the reaction where you think it's going to go. Some reaction higher off that level would be positive, and that would allow you to enter long trades with a stop below 138. So, you know, buying into the level as it approaches is probably not as good a plan, although there will be some people out there who would swear by it, because obviously you're looking at some long-term support levels. But there's plenty of time to get into these markets. That the markets are chopping about and moving about regularly, 150, 200 points on a daily basis. So, you know, don't be in a rush to get into a trade. Just make sure your plan is in place. You've got a good stop in there, you know, and you manage your money well, and you're disciplined. Sounds easy, right? So we're making new lows now, or have done this morning. We were looking to sell this morning, but never really got close to our trigger level. GBP, where could it pull back to? 143 maybe. Yeah, yeah. I mean, we were looking. Let me just bring our. Sorry, I can't show you our page for some reason. Let me try and get it up. Yeah, let me try one more time to get it up. Right, dashboard. Here we are. You can see the dashboard, fixed dashboard. This is our dashboard. Yeah, there's a FTSE idea this morning, buy 59.80, cable, all the products. Cable, we were looking to sell at 143.50. So unfortunately, nowhere near. Didn't rally to where we expected. We were looking to sell it here. Just carried on going lower from there through where our target was 142.50. You know, so it's a real missed opportunity there. But yeah, if we trying to look for something good to say about cable, but I really am struggling. Let me just hop back to the chart. Let's get some signals on here. Let's get the moving averages on there. Let's get the Ichimoku cloud on there. And let's get a decent EMA on there. I like the 8 EMA. Yeah, so at this point in time, I'd be looking to sell rallies back up at 141.65 on a short-term basis, that is. Otherwise, I would be looking to sell into rallies at 142.50, 143. So let me just try and get. I've lost my chat. Yeah, got my chat back. So targets, but what, a break of 138 pan? Yeah, you're looking at a serious downside if it does break and close below there. I am optimistic that the support will hold, but from a medium-term perspective, we'll be looking to sell into rallies still, targeting these lows. Obviously, the new low this morning, a significant low. You know, and you go on the weekly chart. Weekly close here at 139.93. So around about the 140 level will be a good psychological support, backed up by this weekly close at just under 140. But again, high risk at the moment, and obviously this is the UK issue. Let me just flick across. I prep any dollar yen. Yeah, dollar yen. Again, we're talking about head and shoulders reversals. This is a great one. Head and shoulders reversal. It could have been drawn in a couple of ways initially. This one seemed to work well with a pullback to test the breakout, the neckline, and the continuation lower. And this is what I was saying about head and shoulders reversals. You have to have this large rally into the head and shoulders neckline, head, neckline, shoulder, break, test it, and then lower again. So this has got, let's see if that's actually achieved close to its target. Yeah, I mean, that's through its target on that formation. We break it down, it still looks bearish. And we're having this consolidation over the last few days, last week or so. After 4 consecutive days, we're looking at a lot more positive day to day. We were seeing this like dollar strength coming back in. Now, is it temporary? Difficult to say, but you know, it's basically a one of those markets that really sort of like does get sort of thrown about, where you have the volatility in there at all times. This morning on this trade, we were looking to sell into this rally. I think on a shorter term time frame, we were looking at a failed rally and a move lower to try and test these lows again. And here, after sort of 4 consecutive down days, expecting another down day. Wasn't too, the market had rallied overnight, so we were looking to sell into a rally 113.20. Target on that was 112.50. So it's trading around 132 to 113.20, our entry level. Stop on that is 113.55. So again, if you look at that, it's a 35 tick loss against a 70 tick profit. So exactly 2 to 1. So medium term perspective, we're negative on this. We'll be looking to sell in the area around about 114.50, targeting lower levels. If this dollar rally does not continue and this bearish flag pennant type formation plays out, you could well be looking at a move lower to 105 in sort of no time at all. But you know, dollar holding at the moment and trying to fight back today. So Mr. C, dollar yen pullback level as Nikkei test 17,000. Yeah, we were looking at Nikkei earlier, and yeah, that's pretty much it's very much an equity driven story at the moment. So I hope you found this beneficial today. Any questions? Quite happy to take them on our website, contact, or through the chat. Feel free to buzz me with any news or views, and if you enjoyed the webinar, great. My name's Steve O'Hare. If you did enjoy it, my name's Ian Coleman. Hopefully I'll speak to you again next week. Take care, guys, and trade safely.